Hello and welcome to another Westpac Financial Markets video. I'm Sean Callow and joining me today, Head of Commodity Research, Robert Rennie. Welcome, Rob.
Great to be here. Thanks, Sean.
Now you'll be updating us on the commodity side, and obviously Aussie dollar very closely linked to commodities. But I must say, if we're thinking about what's really driven the Aussie over the past few weeks, it's been more about the Fed expectations. So the Aussie got to about 68 cents into year end, but it's come back down again to 65 cents. So this has really been the main driver of the Aussie against the US dollar, at least. We had in December, the US dollar came under broad pressure from the FOMC statement. They're talking about rate cuts. When are they going to do it? The market got pretty excited. And so the Aussie rallied all the way up to 68, as I say. But then sort of second thoughts, a bit of resilience in the US economy, and the Aussie came back down. So this week we've had the FOMC meeting again, and a lot of market attention on it, and a little bit of a different message from the Fed, I'd say. From Jay Powell in the press conference, he's essentially saying, as of current information, we probably won't cut rates in March. So that's been a big deal for the Aussie dollar, for markets, and equity markets are watching it too as well. So those have been the main swings for the Aussie over the past few weeks, but obviously there are always many factors that are in play for it.
Yeah, Sean, that's really interesting because obviously one of the factors that's been so interesting, I think, from a global financial market point of view, and obviously from an Australian dollar point of view, has been just the incredible volatility that we're seeing in oil and energy markets. And look, maybe one of the points to sort of emphasize here is, as a result of the ongoing Ukraine situation, the dynamics and flow of crude around the world really has changed, and I think it's really exacerbated the current volatility. So sort of traditionally, the West used to get an awful lot of its energy from Russia, and the East used to get an awful lot of its crude from the Middle East. But as a result of all of the bans and sanctions that we've seen in Europe directed towards Russian crude, that Russian crude is now coming down through the Suez Canal, through the Red Sea, and then down through that very sort of narrow straits, Bab el-Mandeb Straits, which is between Yemen and Djibouti. At the same time, the crude that would have gone into Asia is now heading north through the Red Sea, up through the Suez Canal. And then we have the situation Israeli-Hamas. We have Houthi rebels firing missiles at vessels.
The Red Sea, where's that oil going? Is that heading to Europe?
The crude from Saudi is heading from the middle of the Red Sea up through the Suez Canal. But once you start firing rockets at LNG, crude, or at product carriers, what you find then is the cost of transportation increases tremendously. So we're seeing evidence in the financial press of the cost from shipping a barrel of crude from Saudi up into the UK rising from somewhere in the region of sort of $3 to $5 per barrel up into the 8 to 9. And there's some experts in the market are suggesting that we could see hot prices as high as $19 per barrel. Now, if you think about the cost, if it costs you $19 to transport a barrel of oil that costs $75, the increase in cost that we're going to see, not only are crude prices rising as a result of these missiles flying around all over the place, but the transportation costs are rising so much that ultimately the cost that we're going to see, when we fill up the car, is going to have to rise.
But it hasn't risen that much yet, because
correct.
I mean, if we do it with the invasion October 7th,
yeah,
the prices since then haven't exploded. We're not at 110.
Nope.
Is that just supply?
Ultimately, it's supply.
There's enough, is there?
There's more than enough. Remembering that OPEC late last year, they announced supply cuts. Those supply cuts have come into effect in the first quarter of this year, and the expectations are that we're going to have to see those supply cuts continuing. I would make the point, though, that crude prices probably should have risen somewhere in the region of about $7 so far this year. That's what my fair value modelers are saying. And that's just on the basis of we've had extreme weather in the US, which has crimped production. We had the hangover of Russian bans on liquids through the end of last year as well. And obviously, we've seen ships, instead of going through the Red Sea and the Suez Canal, they're taking the long way around the Cape.
Increasing the shipping.
And that's basically seen inventory levels around the world drop quite significantly. Okay. That's boosted prices. But I would agree with you, we probably should be higher than we are.
Risk is very, very much to the upside, but so far they haven't really got through. One thing we have seen is that we had Australia's CPI this week, and it printed the fuel prices were actually about flat in the quarter, which is not a bad outcome. People certainly notice that when they go and fill up their car. But that was only one of the factors. The CPI overall in Australia did print on the soft side, so that's encouraging. We've got the Reserve Bank coming up. Certainly markets are expecting that there'll be no change for a while, but market pricing has come up. People are starting to talk about rate cuts, that obviously that could hurt the Aussie dollar. They're priced for more than 2 rate cuts by year end. But probably not too soon. So that's really been one of the factors that's in the background for the Aussie. It's probably not too bad. It's sort of one of the factors weighing a little bit, the rate cut talk.
But when's Westpac calling the first cut?
The second half of the year, I think not before September is the phrase at this point. So that's where we're looking there. The other factor, obviously, always moving the Aussie is China. So they've taken dramatic steps to try to shore up their stock markets. But it was amazing to see in January, we saw US stocks record high, China stocks 5-year low. Now that finally seemed to wake up the government there. They've taken a number of steps, but it hasn't really made much difference. But one thing I will note is, though, that iron ore's held up okay, so that's got to be positive for the Aussie. We've got a lot of negatives from China, but I mean, just briefly, what are we doing at $130 on iron ore?
Yeah, I must admit, over the holidays, I was really scratching my head as to why iron ore prices, we got up into the early 140s late last year, early this year. I was really surprised by that, because as we got into the end of last year, Chinese steel production collapsed to some of the lowest levels that we've seen on a multi-year basis. Now, that was because China has steel caps in terms of production. So the last month of the year, suddenly everyone realized that they had to cut production to get in underneath the steel caps for the year. But we've actually started the year with a bit of a rise in inventory and lower production levels as well. And that would really question why iron ore prices are still in the late 120s, early 130s. So
risks very much to the downside.
Risks are towards the downside.
100 or below? No.
Look, in the short term, I'm sort of thinking 110, 120. Every time I've tended to think that we would fall much beyond those levels, though China will come up with another stimulus measure, which has been probably just enough to prevent the equity, the Chinese equity market from falling an awful lot further. And obviously that's important for the Australian dollar as well. Yeah, so they've obviously, at least they're taking steps. So I think that does help shore up the Aussie, that at least action is being taken there. So it limits the downside a bit. So as always, thanks very much, Rob. There's always a lot going on with the Aussie dollar, and that will continue to be the case. So we'll discuss that next time. So thanks for watching. Thank you.
The content of this recording is informational and of general nature only, and is not intended to constitute a research report or reflect any recommendation or financial advice. It has been prepared without taking into account your objectives, financial situation, or needs, and investment decisions should not be based on it. You should obtain your own independent advice before proceeding with any investment decision. Whilst every effort has been taken to ensure that the contents are correct and any opinions, forecasts, conclusions are reasonably held based on information at the date of recording, Westpac does not make any representation or warranty as to the accuracy or completeness of the statements or information contained in this recording, and any liability therefore is expressly disclaimed to the extent permitted by law. None of the material included in this recording should be copied, published or reproduced in whole or in part without the prior written permission of Westpac.